Hi, everyone. So I'm absolutely thrilled to be with you today to talk about the very challenging and the very important topic of the energy transition. And before we go deep into what's happening today, I want to take you back to a simpler time, a less complex time. This is an ad that was run in 1962. I fact-checked this by Humble Energy, bragging that they were supplying enough energy to melt 7 million tons of glacier. Because the world was simple. You had a growing economy, you had a need for energy, and Humble was supplying that energy, powering businesses, heating homes. We wouldn't be here without energy. And the truth is, well, the vast majority of the energy today comes from a source that we need to transition out of. And that will not happen overnight. And that will be complex because energy is not something out there. It is something that is deeply connected to everything that we do. And so today, we're going to explore a little bit why this transition is actually happening, why it's happening probably faster than we think, and how finance and long-term oriented businesses can think about how they position themselves within this transition. What's really interesting is that we've moved from this very simple world of we need energy, let's get energy, and let's burn it. We're starting to think a little bit more about the purpose of that energy. And the reason for this is that we've actually evolved over the last decades. And I don't have to go into this in too much detail because Bertrand gave a very good overview of the shift we've seen over the last kind of 40 to 50 years from a view that was very much grounded in the 1980s on shareholder value creation, where similar to energy, money and business, and the purpose of business was to do more business and to profit, with a complete ignorance of the externalities on Earth and society. These were viewed as separate things. You took care of business, environmental and social issues would take care of themselves. We, of course, know that this is not true. And over the past decades, we've had a huge amount of research and information that is now at our fingertips that shows us that we need to take these things into account. That business, just like ourselves, doesn't evolve in a vacuum as an island separate from everything else. And so from shareholder value creation, we moved towards the 2000s, this is really when I was studying, into the notion of corporate social responsibility. Michael Porter's theory of creating shared value. Businesses started to see that there was actually a case to create some products that some consumers would buy for a premium, a sustainable option, a better for people option. And this took off. This is great. We started to connect the dots, say, actually, we probably want to start bringing a little bit more of this environmental externality and start to understand these social externalities. But it remained a really small part of the overall business, 5%, 6%, 10% sometimes of the bottom line of companies. We, of course, know this is not enough. We cannot afford today to continue with a 5% that has transitioned or is moving and a 95% that is in a business as usual mindset. And that's what's really interesting about where we are today. And of course, sometimes in the short term, it's hard to see that we're there, right? We still operate under the old paradigm, but where we are today is a growing understanding that we are in an embedded economy, this famous donut economics, that business and finance within it operates within the constraints of a life-giving planet, these famous planetary boundaries that actually articulate the ecosystem services that sustain human life on Earth. It's not about saving the planet. In fact, talking about saving the planet is very far removed from the reality we're faced with. It's about ourselves. It's about sustaining human life and the societies that have thrived within these conditions over the last 10,000 years. We heard Roberta at the beginning. We've been here for 3 seconds. And I believe we'll be here for a lot longer because we have an emergent understanding that we are embedded, but we are not just embedded within a planet. We have social foundations. When there is war, when there is rising inequality, people do not think about the long term. Unless we secure people in their lives, in French we say, c'est la fin du mois, pas la fin du monde, the end of the month, not the end of the world. You must secure people in their day-to-day. And the more you dig into the energy transition, the more you understand that unless we solve for the social foundations, we will not be able to transition with the speed required. So it's all about putting the human at the center, which resonates very much with what we'd heard before. We must reconnect to each other, and we must reattach the financial system and the economic system to the physical realities of our planet and our planetary system. So this is happening when we read big headlines around the rise of ESG, so environmental, social, and governance investing, or impact. This is the beginning of the journey to doing that, to reconnecting, or to maybe we could say connecting our economic system for the first time to the realities that our world operates in. The challenge we have is that this is not the responsibility of states. This is not the responsibility of public sector, private sector, consumers. This is a collective responsibility. If we look to the state only, the state has a role to play. We all have a role to play. But if we look to the state only, what we will see is that there are many trade-offs and challenges right now for public actors globally. This is just an excerpt from last year of the debt burden and the spending in health, defense, and the environment across Germany, Japan, and the US. I took some of the the larger kind of developed economies. And you can see, well, I'm still happy to see that health is supposed to be outspending defense, but we all know what direction that's going. And if you look at the relative size of environmental spending, well, we're really very far off where we should go. And so this is something that the public sector and the private sector need to work on together in partnership, hand in hand. And some solutions, many solutions will also come from the private sector, from the markets. And I'm telling you this as someone that's been working in finance for 16 years. I don't work for an NGO. I work in an organization that's been around for 200 years and plans to be around for another 200. And we understand that if we are to adapt, if we are to still be around in 200 years, we have to be part of the solution. And we have an interest for our clients in understanding these complex dynamics and making sure that they can benefit from the opportunities, but also understand the risks. So what is our purpose at its core as a financial institution? Our purpose is to support the real economy. And we forget that. We heard Bertrand this morning talking about the financial crisis. The financial crisis was the result of money seeking to do money only, profit seeking profit, a complete absence of purpose. So our purpose is to drive and to foster and to support a real economy that is in the service of the human being. We do this, we think, through 3 things. First, through investing in the solutions that are needed to drive the transition to a low carbon and nature positive economy. Today, steel, cement, some of these what we call hard to abate sectors have no alternatives. We need to invest massively in alternatives to get clean, green cement, steel, and many of these other areas. So continued investment needs to go in there. What's really interesting is a lot of investors have understood this. One of the fastest growing categories in the so-called responsible investment space is actually in sustainability-themed strategies. It's in strategies that are directing capital towards these solutions that are needed for the economy of tomorrow. The innovation within planetary boundaries. I would even go further and say that innovation that is not within the planetary boundaries and without taking into account social foundations is not innovation, it's business as usual. And these investors have understood this. This is a category that is growing at a CAGR, a compound annual growth rate of 60% over the last 5 years, and growing. You know what is not growing? Negative screening. Strategies that I would call old school ESG that focus on exclusion. Because we will not exclude our way out of this mess. There are no sectors that are inherently bad and others that are inherently good. All of it needs to move. This is our second role. Our second role is investing in those companies and those economies that are transitioning. Because the issue is that 95% of our economies need to move from high carbon to low carbon, from highly water intensive to low water intensive, from linear to circular, from a take, make, waste model to a model that is circular and regenerative. And today, the good news is that if we look at climate, if you look at the MSCI World All Country that takes the companies that are listed globally, about 30% of the assets within the MSCI World 100 all countries, have transition plans, have strategies with regards to moving towards a low carbon world. Are they perfect? Probably not. Are they net zero today? No, they are not. This is about moving to the right place. And as investors, meeting thousands of companies on an annual basis, our job has always been to keep them accountable to what they say they will do on a strategy level in order to foster their business over the long term. And this is no different. And so investing in the transition is also where you have huge opportunities today, because I was talking to you about those sectors that are hard to abate, where we need new technologies. The truth is, a lot of the technology that we need to move is actually already available today, but it needs to be deployed at scale. It's a volume game, but it is a very interesting proposition. Take the example of Vietnam. 5 years ago, Vietnam was 190th in terms of solar capacity deployment. In just 4 years, it is today in the top 10. It is 9th. How did it do it? Public policy, a government that was pushing for it. They got people on board with incentives to the market saying you can sell your energy back to the grid for 20 years at a fixed price. And they had capital, because this is one of the markets that people invest in. So change can happen much faster than we think when you have these things that are aligned. And as investors, we have an interest in looking at this. Finally, we have to engage for change. Because while you have solutions providers, it's about 5% of the market, and you have the transitioners, maybe about 30%, depending on the economy you're looking at. Well, about 50% of the companies out there that we looked at, if you look at the global market, don't even have a plan. And that's okay. That's normal. We all have different transition pathways. So what we're looking for is to partner with the companies in which we invest to ensure that those that haven't had plans, that haven't put plans in place, are putting those in place. Those conversations help us also identify which ones have credible pathways and which ones don't, i.e., which ones leave our clients open to risk and which ones give our clients opportunities. It allows us to engage with our clients to broaden the conversation with a global client base around these very material and important topics for them, sometimes for their own businesses, sometimes for their own economies, depending on where they're working. And finally, to engage with the broader community, because we must be walking the talk as well. So there's something to care for all. If you have a risk return focus, because I often hear older client relationship managers telling me, my clients don't care. The matriarchs, the patriarchs. This is not top of mind. Do your clients care about risk return? Because if they care about risk return, they care about the increasing cost of natural disasters linked to runaway climate change, which cannot be hedged or diversified away from their portfolios. If they care about return, they will care that if you don't take into account what is happening all over the world with the Inflation Reduction Acts in the US, with the Green Deal in Europe, with the Canadian, we have like a fear of missing out moment right now where globally all countries are coming up with their own transition plans. And as a global investor, we need to understand that. So if they care about risk return, they have to care about what is happening right now in the transition. Do they care about opportunities? Do they care that the green hydrogen market is set to potentially outpace the liquid natural gas market in the next 10 years? Beyond the energy that we put in our economies, the energy we put into our bodies, our food systems, global health and wellness market growing at a record pace. Why? Because of this awareness pushed also by technology, which we heard our previous speaker speaking about. If you care about opportunities, you want to get in early. This is where you go. 20 years ago, we launched a water strategy to get water from A to B in the best quantity, best quality possible. No one wanted to manage that fund. Why did no one want to manage that fund? Everyone wanted to manage technology. We found one manager that was like, water, I get that. That's a challenge today. That'll be a challenge in 20 years. There's a case. He's sitting on 70 billion franchise today, which is one of the largest franchises of our group, all in environmental and social strategies. The opportunities are enormous if you know where to look. And finally, we do have a huge amount and growing amount of clients that are purpose-driven. And in fact, we're human beings. We care often about many of these things. And purpose is growing, right? We see the WEF that has launched this Giving to Amplify Earth initiative, looking to foster philanthropic capital, and the 810 billion going into philanthropy today, only 2% of which is going into environmental solutions, to use that as catalytic blended capital to grow to almost 3 trillion and grow infrastructure projects. In this region, you are seeing a wealth transfer over the next 7 to 10 years of $1 trillion to the next generation that is asking for more purpose as well. This is why we're in this room. So maybe I'll leave you with this as you go on this journey. I've not written a book, although I think I might have to because I'm the only one that's been on stage so far that hasn't. But I have been working at Pictet for the last 16 years, trying to drive change in the financial system. And the way that we think about it, and maybe this is what I'll leave you with, is when you're trying to go on this journey within your business, within your country, within whatever sphere of activity, try to take a holistic approach. Don't just look at what you can do outside. Look at what you can do inside. We've looked at what we can do as a firm, our own balance sheet, our own philanthropy, our own direct environmental impact, employee engagement, and our advocacy. What do we put out there? Why am I standing here in front of you today? But if we do not look at our core business activities, the 700 billion we manage on behalf of our clients, we're missing a trick. If we don't have plastic straws at the cafeteria, but we are ignoring environmental, social, and governance factors in our clients' investments, we are not providing them with the products and solutions and the advice that they need for the future. We are not engaging with the companies in which we invest if we do not disclose these things. And if we do not do the research necessary to understand where the 200 next years will take us, we are missing a trick. So when you're thinking about your purpose journey, always look at this holistic view. Internal, external, consistency, integrity, coherence. And on that note, thank you very much for your attention and have a lovely rest of your day.